That's right. It's Money Life market call time. You know it. You love it. You've waited all day. And now the payoff. And it's a big payoff today because my guest is Elliott Gue. He is the editor of the Energy and Income Advisor newsletter. Always fun to have him on. Also his colleague, Roger Conrad, because we know you like income-oriented stocks. We also know there's a lot of interest in energy stocks here as well. Now, if you have that interest and you want to take it to Elliott's place of business, then you're going to go to energyandincomeadvisor.com. You can also go to capitalisttimes.com. That way you'll learn not only about Elliott's newsletter, but Roger's newsletter and more. And if you want to follow Elliott on Twitter, he's at Elliott_Gue, which is Gue. Elliott, welcome back to Money Life.
Good morning. Thanks for having me on.
You've got a very specific methodology that you use, and it's important that people understand that, because as much as they would love to go straight to what are you buying and what are you selling now, it's meaningless without understanding why. So explain the methodology and what you look for that makes something stand out to you.
Well, we're definitely deep dive type analysts, and we start from a top-down outlook. So we really look at what's going on with not only the U.S. economy, but what's going on globally with the major economies around the world. And, what does that mean for individual segments of the market, what individual industry groups? For example, we do a lot of work in energy. And, in fact, as you probably noticed from the name of my newsletter, Energy and Income Advisor, we really focus on that industry group. So it's very important to get a feel for what's going on in the global economy in terms of oil demand and also oil supply. So we start from that top-down outlook. And then we really drill down from there into individual industries and sub-industries, and then into individual stocks. And we really focus on a very deep dive outlook, especially in the energy industry, where we attend a lot of industry conferences. We participate in a lot of conference calls, and really drill into the individual companies and try to get a real feel for what's going on with their business. And we think that by really focusing on, in particular, the energy segment, we have a much better idea about what's going on in that industry and with individual companies, and that really gives us the edge in terms of recommending stocks.
Right now, obviously, energy in the name of the newsletter, something that you focus on. Let's turn there for just a second, because energy has been a very confusing place for a lot of investors. In fact, if you listen to this show, it seems like every three analysts we get on, you got one who's like, oh, yeah, I really like energy right now because everything is sort of bargain priced. You get another one who goes, no, there's way too much pain. I'm not ready to buy it. And you get a third one who's somewhere in the middle. Where are you right now when it comes to energy and the outlook?
Well, we've obviously seen a big fall in oil prices since the summer of 2014 and somewhat of a bounce since the March time period for oil anyway. We really don't believe this is we've seen a bottom in energy. In fact, we think our view is really lower for longer. We think that oil prices are going to remain stuck in a lower range than many people expect, sort of that $40 to $60 a barrel range over the long term. And the reason really has to do with supply. In the U.S., obviously, we've developed a lot of these shale oil and natural gas fields over the last few years, such as the Eagle Ford Shale of southern Texas and the Bakken Shale of North Dakota. And we've seen a big growth in oil production from these plays. And if you look at U.S. oil production in 2005 or so, was around 5 million barrels of oil a day, a little under 5 million barrels of oil a day. Now we're producing 9.4 million barrels of oil a day in the U.S. So that's more than a doubling in U.S. oil production over just the last 10 years or so. So we think that growth is actually going to continue despite the fact that oil prices have fallen. If you look at the rig count, the number of rigs actually drilling for oil and gas in the U.S., it's basically more than halved since October of 2014. And so I think a lot of analysts are looking at that and saying, there's about less than half as many rigs drilling for oil in the U.S. today as was the case back in October of last year. So we've seen this big reduction in the rig count. So oil production must be coming down in the U.S., but that's actually not what's happening. If you look at where those rigs are coming off, they're coming off out of a lot of the higher cost plays. So if you look at a lot of the shale fields around the U.S., like the Bakken, there's a very defined fairway of those plays, and that fairway is the most productive acreage in that play. And if you go on sort of outside that, wells there are much less productive. So what we've really seen is the major oil producers have shut down rigs that are operating on the periphery of these shale plays and concentrated their attention on the core of the shale plays. And if you listen to a lot of them, a lot of the management teams, and this is one of the reasons that we're so careful to listen to so many different company conference calls and all these different industry conferences. You talk to these management teams, and they're saying, we can make as much money today with oil around $60 or $65 a barrel as we made 2 or 3 years ago at $95 per barrel, because we've become so much better, so much more efficient, so much lower cost in terms of targeting these shale fields. And so what we see is that when oil prices are low, as they were in the first quarter or so of 2015 of this year, a lot of these companies slowed down their drilling activity. They also did a lot of what we call frac log, which means that they drilled wells, but they didn't actually put them into production. And the idea is that they'll put them into production when oil prices recover a little bit. And for most of these companies, recovery means oil prices around $60 or $65 a barrel. And we're not too far off that right now. And if you look at 2016 prices, futures prices, you can hedge a lot of oil production well over $60 a barrel in 2016. So what's happening now is a lot of those companies are putting those wells that they put into frac log in the beginning of the year, they're planning to put them into production in the second half of 2015 and into 2016. So I actually think we're going to see, if anything, a very short-term sort of leveling off in U.S. production growth, and then we're going to see production start to ramp up again in the second half of this year and into 2016, and that's going to put downside pressure on oil prices again. Longer term, what are we looking at? Well, anytime oil prices get up around $60 or $65 a barrel, these companies can very profitably produce out of a lot of these core shale fields. So it's going to be very difficult for oil prices to reliably rally above that $60 to $65 a barrel area. And so I think we're really stuck in that sort of 40 to 60 range over the next few years. That's not good news for a lot of these energy stocks. I know a lot of people are talking about bargains in the energy space, but if you look at a lot of these big producers like EOG Resources or XT or Pioneer Natural, these companies, the stocks really haven't fallen all that much from their highs in 2014, and we believe that those stocks haven't really fully priced in a lot of the decline in oil prices. Those stocks are really pricing in a rapid recovery in oil prices to the sort of $70 or $80 a barrel range, which we think is highly unlikely. So we were actually recommending that people sell a lot of those big shale producer names. Okay,
so give us a couple of a big shale producer name, et cetera, and give us an idea of what comes through all of that to be a buy as well.
Sure. Well, looking on the shale producer side, a couple of the biggest names are EOG Resources, symbol EOG, and also Pioneer Natural, symbol PXD. Both those stocks have come down, of course, since the summer of 2014 when oil prices were still up around $100 a barrel. But they're both trading at levels that suggest to us that oil prices are quickly recovering to that sort of, again, that $70 or $80 a barrel range. We think that both those stocks could see an additional 30% downside just to price in oil prices averaging in that sort of $40 to $60 range over the next couple of years. So we really wouldn't be interested in buying those names unless we see another 30% or so of downside where they might become interesting from a valuation perspective. EOG Resources, for example, currently trading around 3 times book value. Typically, that stock has bottomed out as it did in 2009 when oil prices were low back then. It bottoms out around 1.5 to 2 times book value. So you can see just from that simple calculation how that could see a lot of additional downside from here. Also, we'll be very cautious about a lot of the services companies. These are companies that basically do services related to the drilling or production of oil from shale. Names like Schlumberger, for example, symbol SLB, great company, outstanding company, best of breed. But again, this company is going to see slowing growth over the next couple of years and reduced pricing power simply because of the decline in shale drilling activity. And what we're hearing from the shale producers is the shale producers are saying, look, we want to cut our services costs so we can make money at lower oil prices. And the services firms are kind of agreeing to that. And so they're accepting 20% plus reductions in basic services costs, that's going to pressure margins. So we'd also avoid names like Schlumberger and Halliburton as well. Where we are focusing on our buys is on areas like midstream energy. These are companies that own pipelines, tankers, et cetera. This type of business is not very commodity sensitive. These companies accept a fee for moving oil around the U.S., for example, and that fee has absolutely nothing to do with the price of oil. So we're really focusing our attention on the midstream area right now.
Well, now we're going to see what you like and dislike about some names that my audience is particularly interested in.
Play Hold It.
You got to know when to hold up.
Or Fold It.
Know when to fold up.
It's Hold It or Fold It time with my guest, Elliott Gue. He is the editor of the Energy and Income Advisor. If you want more information, energyandincomeadvisor.com, capitalisttimes.com. He's on Twitter at Elliott_Gue. You know how Hold It or Fold It works, so we're just going to jump right into it. Now, we've been talking about the energy space. We're going to start with, the first of 4 requests we're going to get today from Joe in Colorado Springs. It's for Cheniere Energy Partners. That's ticker symbol CQP.
Yeah, Cheniere Energy Partners is an MLP which is focused basically on the export of liquefied natural gas, or LNG, out of the U.S. We think this market's way overhyped. If you look at U.S. natural gas prices and adjust them for liquefaction and transport costs, actually not much of an advantage for exporting U.S. natural gas to Europe or Asia. So we think this area is overhyped. We'd be a seller of CQP.
That was a sell on Cheniere Energy Partners, CQP.
Sell. Yes, precisely. Yes.
Next, for Joe in Colorado Springs, it's GasLog, ticker symbol GLOG, GLOG.
This is actually an area we think is interesting. Right now, there's an oversupply of liquefied natural gas carriers to transport LNG around the world. But by 2020, we think that overcapacity is going to be completely absorbed as new projects come online. So we think there's a pretty good business in transporting liquefied natural gas and in owning these big carrier ships to do that. We like GLOG, but we also like their master limited partnership, which is symbol GLOP, GasLog Partners, even more. Offers a nice 6% yield on top of the growth in the overall liquefied natural gas market.
So it's a buy on GLOG, GasLog, but the preferred buy is GLOP, the master limited partnership that is also for GasLog.
Bye, yes.
Next request for Joe in Colorado Springs is Royal Caribbean Cruises. That's RCL.
Yeah, they've had a couple of bad quarters, but we actually think that market's going to see a little bit of an uplift, partly because of the decline we've seen in oil prices since last summer. That, of course, lowers the cost of all that bunker fuel that goes into those gigantic cruise ships. But it also means that people have more money in their pockets to spend on discretionary purchases like taking a cruise. So we've actually seen somewhat of a strengthening in, for example, cruise demand in the Caribbean area. So we actually like Royal Caribbean, symbol RCL.
That's a buy. Get on board, as we sometimes say, or get left behind. That's a buy on Royal Caribbean, ticker symbol RCL. Joe in Colorado Springs gets his 4th request of the day. This for Marriott International. It's MAR.
Again, another name we like, Marriott International, heavy U.S. focus, so it doesn't have a lot of exposure to the euro-dollar or the yen-dollar exchange rates. This company also, we like the fact that the U.S. hotel market looks a bit undersupplied. Not a lot of hotels, of course, were built during the financial crisis and right after, so demand for hotel rooms is exceeding supply. This company's raising the rates it can charge people at hotels around the country, and it's cutting the amount of discount rates it offers, for example, for corporate clients. So we like Marriott International, and we think that's a buy here.
Winner, winner, chicken dinner.
It's a buy on Marriott International, Class A, MAR. Last, for Josh in Petaluma, California, it's Cameco Corporation, CCJ.
Yeah, Cameco is a giant Canadian uranium producer. We think it's the best of breed in that market. However, we don't see much upside for uranium in the short term. It's still an oversupplied market. There's more uranium out there than anybody knows what to do with. The prices have been kind of weak and trading at low levels. we would rather buy this when uranium prices start to rally again, which we think is still a year or two away. So good company, but not one we'd buy now. We think this is a sell for now. So
good company, bad stock on Cameco Corporation, ticker symbol CCJ.
Oh, boy, that sounded bad.
Well, it sounded bad about the last stock. What sounded great was chatting with Elliott Gue. Elliott, I'm really disappointed we're out of time because I have like a bunch more questions I wish I could ask, so you're just going to have to come back again in a couple of months.
Thank you very much.
Elliott Gue is editor of the Energy and Income Advisor. I look forward to having him back on the show, but if you don't want to wait, you're going to go to energyandincomeadvisor.com and/or go to capitalisttimes.com, where you can also learn more about the sister newsletter run by Roger Conrad. You can also follow Elliott on Twitter. He's at Elliott_Gue. All right, we are just about done with the June 4th edition of Money Life, but we're going to cross the finish line together and wrap things up right after this message.